we're very happy to have Carolin Pflueger today. She's going to talk about monetary policy and asset prices. The dynamics are like this. Whilst Carolin is speaking, you can, if you have a question, which we encourage you to do, you can do the hand raise thing, or you can write it in the chat. And whenever I find the right time, I will, pause Carolin. I'll call upon you to ask your question. Maybe I'll ask a question myself. And that's how we'll do it. And there's going to be a poll at one point, right?
Yeah, I was going to do that fairly early on if I can actually
set up for you
it
right now. I'm working on setting it up.
Yeah, so it's kind of, I just wanted to do that at the beginning, maybe slide 2 or so.
All right.
All right. Okay, I'll get started. Yeah, first of all, thank you so much for inviting me to do this. This is really, really exciting. It's a privilege. For anyone who's here, please do ask questions. That makes it a lot more interesting for everyone and more fun for me. So if you have a question, do feel free to ask and think of it as providing a service to everyone else here. Everyone else will be grateful if you're asking questions. So I want to talk about monetary policy and asset prices, and just as a broad big picture of what I want to talk about is, I'll first talk about why I think this is an exciting topic to think about. So I'll talk a little bit about the empirical facts that are more and more out there, that are maybe just the best known empirical facts that I think are really quite interesting. And then I'll try to talk about how can we think about this in a modeling sense. So I'll summarize the basic new Keynesian model, which is one of the probably the most standard way of thinking about monetary policy. And I'll talk about how this links to how one can link this to asset prices, both in terms of thinking about kind of the asset prices around FOMC announcements, and then also about just do bond risks, risky bonds, safe bonds. Does that tell us something about inflation and the way investors think about inflation, what generates inflation, how monetary policy works? So broadly, this is, kind of an empirical lit review, followed by what I've written up recently in a review paper with Anna Cieslak, kind of how do we think about good inflation, bad inflation in a new Keynesian model. Then I'll talk about my recent JEV paper with Gianluca Rinaldi, where we bring in time-varying risk aversion and think about FOMC announcements. And then I'll talk about my recent paper back to the 1980s or not, where I argue that bond risks are really quite informative about how investors think about monetary policy and inflation. I also want to flag, I just posted a link in the chat to a problem set, which I'd been hoping to make available earlier, but it's here now, so better than nothing. And feel free to have a look at it. It's connected. It basically walks you through the main part of the code for this JV paper that I'm going to talk about. Why does the Fed move markets so much? And we've been putting quite a lot of work into documenting this, making it more accessible. So this is also, you can think of it as a toolkit for solving models of monetary policy with time-varying risk aversion, which are modeled via habits. So this is, quite happy that this is out there now. Have a look. Let me know if you have comments. This is still a beta version, but yeah, there's a problem set here. Okay, so let's get started. So the macroeconomy, monetary policy, and financial markets are intricately linked. And for anyone who ever opens financial news will be aware of this. When whenever the Fed does something, financial markets move a lot, and market observers and people inside the Fed really seem to follow financial markets quite closely, because it's informative about how very informed participants, investors, think about these policies, right? Monetary policy is important. It worked very aggressively during the financial crisis of 08-09. It's worked aggressively during COVID. So this is an important part of the economy, and financial markets can help us think about that. Why do financial markets help us think about that? Well, if inflation is higher, if we expect high inflation, that should make bonds less valuable, right? So if you have a bond that's promised to pay out $100 in 10 years, and now you learn inflation is going to be 10% over the next 10 years, well, not so valuable anymore. So the prices of bonds, nominal treasury bonds, should respond to inflation. And stocks, of course, are ultimately linked to dividends, which we think are linked to how well the economy is doing. So they should also be informative. So financial markets are really are an interesting object here. And of course, we can get data on this at a fairly high frequency. So this is helpful for evaluating what people learn about. But at the same time, in asset pricing for a long time, we have known that financial markets are also subject to time-varying risk premia. So the famous one famous paper here is Shiller's equity volatility puzzle, which did the calculation of how volatile is the stock market versus how volatile are dividends, and just found that the stock market is hugely more volatile, right? So if dividends have an annual volatility of, I don't know, something like 5% per year, maybe, the stock market has a volatility of maybe 15 or 20%. So this is just a hugely volatile stock market. Campbell and Schiller did this log linearized decomposition, and then Bernanke and Kuttner documented something similar around FOMC announcements. So that raises the question whether the FOMC responses, how financial markets respond, can be reconciled with a standard model of monetary policy, or do we need to think maybe about something slightly out of this standard model? And also raises the question whether we can use bonds and stocks as forward-looking indicators of monetary policy, such as the very widely debated question now whether the Fed can maybe achieve a soft landing or not. Just as an example, you can find these quotes in the thousands. This is just a recent one, headline. This was, I think this was Wall Street Journal. Stocks fall after Powell comments latest Fed rate hike. So after a quiet morning, the U.S. indexes were volatile following a Federal Reserve move. So this happens all the time, right? So I think this raises interesting questions. So this is where I would like to open the poll, because I think many of you probably have thoughts on this. And I don't know whether we can do this now.
The poll is live, Carolyn, and people have been answering.
Yeah, people have been answering the poll already.
Okay, perfect.
Do you want me to end it and see the result?
Yeah. Let's have a look at the result.
All right. If there are any last minute entries that want to get in under the bar here, okay. I think it's pretty much finished. So I'm going to end it, and let's see, how do I share the results? Are people seeing the results?
Perfect. Yes, I can see the results. Can everyone else see them? Yeah.
I think we're good.
Perfect. All right. So the question was, strong financial market reactions to Fed policy are evidence that A, Fed policy changes the outlook for the economy. B, investors overreact to the Fed. C, the Fed affects financial conditions and market sentiment. D, the Fed has better information in the markets, or other. Yeah, I think that's a great split. Would anyone like to give an explanation of why they picked the answer they picked?
Just jump in.
Just jump in. I can't really see anything, but if anyone would like to jump in and explain explain their thoughts, you're very welcome to.
So I voted for the financial markets and affecting financial markets and sentiment. And that's mainly because we think of monetary policy nowadays as functioning through the financial market and then affecting the real economy through the financial market as an intermediary.
Great. Yeah. Anyone else?
Can I ask a question, Carolyn?
Yeah.
what do we mean by financial conditions? I've always wondered, like you said, everyone always talks about monetary policy affecting financial conditions, and I always thought that was a little nebulous for me. So how do you think about what that
nebulous is? Yeah, that's right. I mean, I intentionally kept it a little nebulous here because I wanted to be a little bit broad. And of course, you have worked on the banking sector, and how conditions there can effectively work like a change in risk aversion or risk bearing capacity. So I would view that as being encompassed here. We know that sentiment can sometimes look similar, at least for some dimensions, in the sense that if people are I think you can debate whether you want to call habit sentiment or not, in the sense that if you're really afraid of risk, I would call that also something that can be bracketed under these terms. So I agree it's a little nebulous, but I intentionally kept it this way. And I think it's still meaningful because there's this distinction between, do we learn something about cash flows in terms of, is unemployment going to go up, are dividends going to go down? Or are we learning something about how things are priced, given even on top of that? So I think that's what I wanted to get at. Okay, great. So yeah, I wanna show you. If I took this as an opportunity to review some of the facts around FOMC announcements, and yeah, then I'll talk about the basic new Keynesian model, which doesn't have any risk premia, so it's only going to capture this first potential answer to the polls, which is it's about cash flows. And then I'll talk about this model of time-varying risk premia and monetary policy that I have worked on, and then the possibility of thinking about this as a real-time indicator. Okay, so here are some of the facts. So I think this might be the oldest and also the headline fact, which is that around FOMC announcements, and people like to look around these FOMC announcements because we think that kind of narrows in on an interval when we really learn about the Fed as opposed to other stuff that's going on. The degree to which the Fed funds rate gets revised in a narrow interval around FOMC announcements is correlated with the stock return over the same time interval. And so especially when we learn that the Fed funds rate is going to be higher than expected, so positive surprise, this is kind of, you should think about that as a hawkish surprise, the Fed is tightening. That tends to be associated with a decline in stock returns. And this relationship is fairly steep. This is an interesting fact because, in macroeconomics, there is a debate about this. I think it's worth thinking about, is the Fed even able to do anything, right? Some people might argue, well, the Fed is just following suit. There's nothing really to be done by the Fed. But if the Fed wasn't doing anything, then why should we see this relationship, and why should it be so steep? So the question is, can we interpret this sort of fact as the Fed can move the economy, which of course is the rationale for the Fed being there and doing things, or does it move risk premia, or should we interpret this as something that the size of this effect? Should we interpret this as evidence that markets potentially even overreact, and what the Fed mostly doing is, soothing nerves or affecting risk-bearing capacity more broadly? This is for this Bernanke-Kuttner paper. It's an old paper, but it's actually quite rich. So they have some results about distinguishing between the expected change and the surprise change. And they find that the negative, so this is the slope regression of stock returns onto this change in the Fed funds rate. The point that they make is really it's about the surprise, which makes sense because if we know that the Fed funds rate is going to go up, then if our belief is confirmed, if our anticipation is confirmed, we shouldn't really change anything else. Whereas if we learn that the Fed funds rate is going to be higher than we expected, that really should lead us to revise that maybe there's a recession coming. So the surprise change matters. this paper also looked quite closely into outliers. You know, there are always a couple of dates that are particularly large in this dimension. So there's the result, you know, outliers matter, but the result is not just a matter of outliers. There's this distinction between positive and negative surprises, and Bernanke-Kuttner found that there was not much of an asymmetry. So positive surprises, surprise tightenings, look roughly symmetric to surprise easings, which I think also narrows down a little bit what's going on here. So there doesn't seem to be a particular discontinuity.
Carolin, we have a couple of questions from the chat. Manuel,
Yeah.
do you want to go ahead and ask the question?
Sure. In field 1, how much of the slope is driven by the no surprise dots? So if we remove
The zero dates?
that's exactly. If we remove that like clearly shaded part, maybe I see just noise.
Yeah, so I mean, I intentionally grayed out the zero dates here. You're absolutely right. There are a lot of dates that have zero. But you know, what this is mostly doing is it's going to act as a you know, as a residual on the right hand side. So it's gonna add noise to your regression. It's going to drive up the standard errors, but it's not going to affect the slope.
Okay, thank you.
But yeah, completely agree. You know, there's these FOMC dates are popular for a reason. They get us as close to identification as we can in macrofinance. But there are issues with them, which is there are not that many, and many of them are small. So that's just a fact in the data that we unfortunately have to acknowledge. Yeah.
And Michael, you had a comment you wanted to make.
Just wanted to share this link with this nice financial conditions index that the Chicago Fed puts online. So that's always interesting to look at. You know, it's kind of interesting that right now it actually suggests really accommodative financial conditions, although of course, you know, the Fed has been hiking like crazy for the last year and a half. So so that's something maybe a little bit puzzling.
Yeah, interesting. Yeah, I don't, you know, that sounds interesting. I should have a look at it. I don't actually know that financial conditions index, or I guess, no, that's the one that we worked with, right? So yeah, we have, I mean, it's, yeah, I agree. Financial conditions right now are potentially, there are sometimes things that are a little bit surprising. I mean, I've also worked myself on this index, which we call the price of volatile stocks as a measure of risk perceptions or risk appetite that seems to have macroeconomic predictability. And, you know, last update we ran was in September, so it's been a while for now. But at that point, it also looked actually fairly easy in the sense that people weren't really that afraid of risk at the time. So
can I ask you guys, and maybe Michael knows this, but looking at the chart, my guess is that this is driven by the stock market coming back up this year, this index looking looser, and like last year the stock market was crashing, right? It looks like it's the risk category that's doing most of the move. And so it's just a little bit saying like, well, the stock market moving around is like the measure of financial condition. I'm just not sure like if that really answers the question of how it is moving it, that Carolin was asking. Like it's a good, maybe like a summary stat, but it's not getting at the mechanism, I guess. Maybe it's not trying to do that, I suppose, but
I mean, maybe one comment, you know, a lot of these indices are basically just the first principal component of a bunch of risky asset prices. And so you know, if these movements are due to the co-movement of a bunch of different risky asset prices, there's some evidence that this may be like an overall like risk appetite, you know, that this is picking up. And so that would suggest that maybe part of this response is not, you know, expected cash flows in the stock market, but more like the general level of risk appetite that the FOMC is affecting. And but it's also credit spreads, right? They are also pretty compressed right now, and they would also be affected by risk appetite.
Yeah. No, I think I agree. There are a lot of interesting facts around there, and this, you know, this price of volatile stocks that we that we developed in my paper with Adi Sundaram and Emil Serwadain also kind of speaks to that a little bit, I think. And, I think these financial conditions or this, risk appetite can potentially predict the economy. I think my focus today is a little bit more, since what I want to talk about today is more the theory side. I'll try to keep it a little bit simpler, so I can't really talk about credit spreads and all these other things that go into these broader indices. But yeah, I think the general observation that risk aversion moves around, and how much is it going to be moved by monetary policy, I think is the interesting one here. So yeah, so as asymmetry, the other thing, what did I do here? So this is about the timing surprises, which Michael, you know a lot more about than I do, but I just found it interesting that even in this old paper, they actually did this distinction between, is it the nearest month Fed funds future or the Fed funds future that a couple of months ahead that matters more. And they found that you get a larger coefficient, so stock returns respond more negatively to news about the slightly longer term Fed funds futures, which makes sense, because if all you learn is that, oh, the Fed hiked today, but it would have happened anyway next month, of course the stock market shouldn't react much. But if you learn that monetary policy is going in a different direction, that really seems to be what's moving the stock market. So that all also seems to make sense. And of course, there's a lot more recent work on this. Yeah, and then I think there's also an interesting fact in that paper about the cross-section of stocks, which I would actually like to see more exploration of. It's really just in this paper, in the Bernanke-Kuttner paper, it's really a very simple analysis, just split by pharma, French 10 industries, and then running the results separately by industry. And this is a plot for these different industries, and basically against the unconditional beta, so that you have the utilities, which are the low, is a very low beta industry, high tech is a very high beta industry, and then high tech has a response to these monetary policy news that's much larger than utilities. So this relationship of like this high frequency response also roughly lines up with how risky these industries are at a much lower frequency, which is kind of interesting, and to me points to the idea that if there's some, if risk aversion moves around, well, that should affect, if you have a risky stock, should just matter a lot more for risky stocks than for safe stocks. Okay, so this is stocks. There has been since then a lot of work on bonds, which maybe is not quite as, there's not as much consensus there, but I think there are a bunch of interesting results here. So this is from Hansen and Stein, who ran regressions of how much do long-term bond yields move when there's a change in a similar monetary policy surprise. And the main finding here, as I read it, is that long-term bond yields move a lot when short-term bond yields move around FOMC announcements. These coefficients are quite large, especially if you look at 20 years out. Monetary policy operates at maybe a 3-year horizon, 5-year maximum, but 20-year bond yields changing in response to monetary policy news is in that sense is pretty surprising, especially the real bonds. Now, how have people thought about this? There's also this, Nakamura and Steinson have a paper where they look at a similar set of facts and then link it to how much, there's a monetary policy news shock and how is that related to expectations about output growth. So the idea here is that maybe, when there's a hike, maybe what we're learning is that the Fed actually knows the economy is going to do well. And, if you think about your classic Euler equation, higher expected growth should relate to a higher real rate, and then maybe that's what we're learning here. So that's one possibility, which also goes back to this Roman-Roma hypothesis about a Fed information effect. So that's one possibility. And then, Michael, you've written this really nice paper where you've argued, well, maybe this is not quite what's going on. Maybe we just have to take the frequency at which this data is released quite seriously, and maybe this is just an intra-month or between meeting response, we'll learn good news, and therefore the Fed hikes rather than vice versa. So this is, I think this is actually a super interesting debate. All right, and then, this is only, I want to emphasize that this, so far what I've talked about is only really one side of the facts, which is kind of a regression coefficient. How much do stocks and bonds respond to the size of the surprise? But, there are also a bunch of facts around just how do stocks and bonds behave on average around these dates. And there's, for example, it's known that the average level of equity returns is different around FOMC dates, and especially it's higher just before FOMC date. So this is about the level as opposed to a regression coefficient. Sebastian Hillebrand has this intriguing paper recently where he argues that a somewhat longer window around FOMC dates explains most of the decline in long-term bond yields over the past 20 or 30 years. And then there's also interesting evidence around non-farm payroll and other macroeconomic news surprises, which might be informative about monetary policy because, monetary policy should respond to these news, and therefore this should also be priced in stocks and bonds. So I think there are a lot of intriguing facts, and what, how should we think about them? So let's just have a look at a simple new Keynesian model. And this is, I suspect most of you have seen this. This is, basically first year macro, but I want to go over it again just because we want to bring it into the context of asset prices here. And I've written up this summary in an annual review of financial economics article, but this is really not new. It's really just a summary. Okay, so let's think about the three-equation new Keynesian model of monetary policy. Why three equations? So we think of this as an Euler equation, a Phillips curve, and a monetary policy rule. Okay, so X here is the output gap. What is the output gap? It's basically the level of output relative to what output should be if there were no frictions, if all the prices were flexible, if all the wages were flexible. So high X would mean that the economy is running above potential, low X means it's running below potential. Pi is inflation, and then I is the policy rate. I drop constants everywhere here because I'm not interested in the level of any of these variables. I'm interested in how they could move, how volatile are they, and so on. Okay, so what is the Euler equation? The Euler equation typically represents consumers' first order condition for the risk-free bond. So that means that if I is high, if you as a household see a high mortgage rate, you're less likely to take out a mortgage and consume out of this loan. Whereas conversely, if you see a good interest rate, maybe mortgage rates are low, car loan rates are, the rates on a car loan is low, then you're more likely to take out this loan, and that will drive up consumption and therefore output, because in this model, on the production side, output is effectively determined by consumption. So this is yes?
So you've included lagged terms in all of these equations. Is that important?
Good question. So the lag terms, I think, are important for understanding the magnitudes to some extent. And that's why I am including them here. So where do these lag? You're absolutely right. If everyone's perfectly forward-looking, then rho x should be 0, and then that's what you're left with. I think what people have found, and this goes back to some work by Pflueger in the 90s, and Christiana Eichenbaum and Evans also have this, is that this lag term in the Euler equation here is important to capture something in the data, and it's important to capture what empirical macroeconomists have worked on for a long time, which is the hump-shaped response of consumption and output after a contractionary monetary policy shock. So that's what this is going to help me capture. You can model this in different ways. The way Pflueger modeled it is with habits, and that's what I'm going to do too. And I think this is important when you're thinking about asset prices, because asset prices are going to respond differently if you have a spiky output response or spiky consumption response, or if you have a smoother and more hump-shaped output response. Yeah, thanks for the question. Okay, so this is about consumption today versus consumption tomorrow, assuming that you have if you have some lag dependence. Yeah, you can find this in many textbook models. Maybe you want to look at this Gali textbook. The textbook models have constant risk premium. Okay, so we can't talk about risk premium here yet, but I think it's important to start with this as a baseline. And then there's a demand shock here, which I call Vx, and that represents a shift to consumption at a risk-free rate. This can represent a number of different things. It could be a demand for safe assets. So if I really want to hold bonds now, that's going to drive down consumption output, even at a given interest rate. It could reflect a wedge between, the government rate and the rate that I'm facing as a household, right? I can't borrow at the government rate. I don't have access to the Fed funds market. So if there's a markup above that due to credit market frictions, that could show up here. Or also, the literature on that shifting growth expectations can explain business cycle variation. That would also show up here, because if I expect high growth, then I'm also going to consume more at a given interest rate. Okay, so that's the Euler equation and with a demand shock. And then the Phillips curve is basically the log linearized expression of the production side. So this follows from optimal price setting and production decisions when these opportunities to revise prices are infrequent. So this means that when the output gap is high, the economy is running hot, it's expensive to produce, this is going to drive up inflation. And also, if I'm expecting higher inflation going forward, then when I get the chance to revise prices, I'm going to set a higher price in order to protect myself against future price increases in the economy.
Carolin, can I ask real quick, since currently there's a lot of debate about the Phillips curve, and inflation seems to be coming down with less of an output gap than anticipated. Would it be difficult here to have some kind of nonlinear Phillips curve? That's one of the proposals being made for, maybe it's just very nonlinear, and so with only small increase in the output gap, you can get inflation to come down a lot from a high level, and then later on it's very flat, something like that. How would you think about doing it here?
Yeah, no, that's interesting. I don't think it would be super hard to add it. Certainly, if you're only trying to solve the macro side, you'd end up with one or two more state variables, but not such a big deal. I mean, in the absence of in the absence of writing this formally, you can think what this shock here, this cost push shock could reflect is these maybe occasionally binding constraints that change the shape of the Phillips curve, right? So if you think that maybe whatever happened during COVID with the supply chain disruptions or whatever, it temporarily made the Phillips curve steeper, that could end up looking similar to an increase in this kind of shifting the Phillips curve up for a while. And then if we go back to a flatter Phillips curve, then kappa is low again. But yeah, I think that's definitely the interesting debate. I think if you have if there are temporary disturbances to the Phillips curve because of nonlinearities, to some extent, that should show up similarly to a cost push shock here, even though, of course, there are going to be additional forces. But I think just thinking about a cost push shock is probably, for some questions, is not a bad way to think about these things. Okay, and then we have the backward-looking term here is important empirically to capture that inflation is very persistent, right? Inflation has it tends to have in the data a fairly persistent component. That's something that the econometrics literature has worked on. Stock and Watson have a bunch of papers about this. So that's where this backward-looking term comes in. How do you model it? Well, it's admittedly a little bit ad hoc in the models. So you can write it. It has been written down, and that's, for example, what Smets and Vouris did. They wrote it in terms of, well, if you don't get a chance to update your price as a firm, you tend to index your prices to past inflation. Or another way to get a backward-looking term here that's maybe more realistic is that inflation expectations are might just be partially adaptive. They might not be perfectly rational and move a little bit slowly. Yeah, and then so we already talked about this cost push shock. I think it could capture temporary nonlinearities. More traditionally, one thinks about it as anything that increases, that generates a wedge between the output gap and the marginal cost of production. So changes in markups. So if, for example, there's a disturbance to trade relationships and you can't import, now that's going to increase the monopoly power of whoever's left, and that might change markups and therefore increase inflation. Yeah, okay, and then the third equation here is the monetary policy rule, which goes back to Taylor. He just ran a regression of Fed funds rates onto the output gap and inflation and found that the R squared wasn't too bad. So many models have taken this to just plug it into this model, and that's what I do here too. It's pretty common to add an inertial term here because, of course, when inflation goes up, as we've seen, the Fed doesn't hike interest rates by 5 percentage points right away. They do this over time because they don't want to move interest rates too much in one single step. And so then when rho I here is high, this means that the policy rate is also linked to where it is right now and then moves towards this target gamma x times the output gap plus gamma pi times inflation a bit more slowly. So the gamma pi here is, what you would call that's the Taylor principal coefficient. If that's greater than 1, it means the Fed hikes nominal rates more than 1-for-1 as inflation goes up. So that means they hike the real rate at least greater than 0 when inflation goes up. So this gamma pi is how much does the Fed put long-term weight on inflation. Gamma x is how much do they put weight on output. Yeah, and then there's this monetary policy shock, which captures deviation from the rule. And so this is, the Fed wakes up and happens to hike rates, and then eventually this hike mean reverts. Now this might not be a particularly realistic description of how the Fed works. The Fed certainly tries not to be random, but it's how people have most commonly thought about these monetary policy surprises, that there's a disturbance to the monetary policy rule. Okay, so yeah, just to see how these different shocks work, let's have a quick look at impulse responses. And so I want to start with the impulse response to the demand shock. So that's the shock to the Euler equation. That could be something like credit frictions or expected growth is higher. So that's something that drives up demand. And here I have the impulse responses, output gap, inflation, and the monetary policy rate. So when there's a positive demand shock, the output gap in this model goes up, and then it mean reverts. Inflation goes up, but it goes up much more slowly, and the interest rate, the policy rate, also goes up, and then mean reverts. Now, what does this mean for asset markets, which is ultimately what we're interested in? Remember, this is not a model of asset markets yet, but the arrows that I painted in here kind of tell you what we would expect to happen for stocks. Now, higher output gap means the economy is doing well, so this means stocks should go up. Inflation goes up, so higher inflation is bad for bonds, so this means nominal bonds should go down. Bonds and stocks, now this is, I have a typo here. So stocks should go up, bonds should go down after this demand shock. And also the inflation here is of the good type in the sense that inflation goes up, but it goes along with a strong economy. So this is the type of inflation that we're hoping for after the financial crisis of 08 or 09. High inflation is a sign that the economy is recovering. Okay, so this is the demand shock. Then we have the cost push shock, which, remember, that's the shock to the Phillips curve. So this is changes in markups. This means that, first of all, inflation goes up if you have a shock there, and that's typically quite bad for nominal bonds. At the same time, it's these type of shocks tend to be recessionary, so it should be bad for stocks. And that means, we should expect that stocks and bonds fall both after a cost push shock, and that's really the bad inflation. That's the sort of inflation that we really don't want, where inflation goes up, households are suffering because of inflation, and then you also have a strong recession. So all the bad things happening at the same time here after this cost push shock. And then there's the monetary policy shock, and this is, sorry for the slightly different formatting here, but what happens after a monetary policy shock is, first the policy rate goes up, and then it actually goes below the original steady state and then mean reverts. And why is that? Well, this hike in the interest rate leads to lower output. Why is that? Well, higher interest rate means that I want to postpone consumption, I consume less, output goes down, and then inflation falls through the Phillips curve and the price setting decisions of firms, because the economy isn't doing well, it's cheaper to produce, so then firms set lower prices. And because after this shock the economy suffers, the Fed actually ends up easing in the longer term. So that's the Fed hikes rates, the economy contracts, and then eventually the Fed tries to undo some of these movements, because the monetary policy rule tells the Fed that if there's a recession, if output gap goes down, you have to lower interest rates. All right, so that's kind of how I think these are the three types of shocks. All of them, of course, encompass a whole range of things that could be behind them. But that's basically that's roughly how they work. Any questions here? Okay, so then I will, let's just take a 2-minute breather here for questions, because I'll switch gears now and talk about this particular paper that tries to model some of these phenomena, and also adds time-varying risk aversion and says, well, what if we have, the Fed moves the economy, how much movements should we have in risk aversion here? And yeah, so that's also what the problem set is about. And Michael, in case you're interested, part of the problem set is actually a question that we talked about very recently, which is, as gamma x increases, what the problem set asks you to do, one of the things it asks you to do is, as gamma x increases, as the Fed has a rule, if the Fed has a rule that puts more weight on output, what happens to risk premium, the equity premium, the slope of the yield curve, and so on. So that's what you're asked to solve here.
Carolin, can I ask a question, since you're taking a short break? One of the challenges I always thought is that, asset prices are very long-lived, whereas monetary policy shocks typically, the literature finds are not that persistent, or maybe you think otherwise. So isn't there a tension there between where we see these large impacts on the stock market and the persistence of the shocks?
Mm-hmm. Yeah, absolutely. I think that's a very good question, right? So these monetary policy shocks might not be super long-lived. And I think that's, for me, as a reason why it's useful. There was maybe a decade ago, whether in asset pricing, there was the big debate, should we think about consumption-based asset pricing in terms of habits or long-run risks or, disasters, and I think it's actually, I'm very happy that this has become a more collaborative debate, that people aren't quite as vicious about this. I think this is a good application of the habit sort of framework. And the reason is precisely because monetary policy, should act mostly in the short term. And so then the habits answer to this is that, well, any fluctuation in consumption or fluctuations in the economy is going to move risk premia. So to the extent that monetary policy kind of moves the ability to bear risk in either on the household side or in the financial system more broadly, this should move risk premia, even if it doesn't have super long-term cash flow implications. Okay. Any other questions?
We have a couple of questions from the chat. Do you
Yeah.
want to, Maitham, do you want to go ahead and ask your question? Maybe I'll just ask it for, so I'll just ask it for them. So how do we think about long rates in the new Keynesian model? What's the best way to do that?
Good question. So, I mean, the simplest way to think about long rates in the new Keynesian model is through the expectations hypothesis, right? So the simplest way to think about it is that the 10-year rate should reflect the expected short rate over the next 10 years. And that's the simplest way of thinking about it. That's going to hit the issue that monetary policy doesn't operate over a 10-year horizon. It's unlikely that the Fed can set interest rates over the next 10, 20 years, because eventually prices will converge and eventually prices will be somewhat flexible. So that's exactly the puzzle that Hansen and Stein and Nakamura and Steinson pointed out in the data. Now, there's a debate about what's really going on in long-term rates around these dates, and I don't have a full resolution to that. But I do think that risk premia can be important in long-term bonds, and these risk premia might also move in response to monetary policy announcements. So I'll show you some results on that, but I think it's also a space where there's more work to be done. And Michael and I have an empirical paper that speaks to that a little bit, where we have a measure of this gamma X, or it's roughly related to this gamma X in this model. We measure this in the data using surveys, and we show that that's related to the term premia in long-term bonds, which is exactly what you would expect if gamma X changes the co-movement of bond returns with the stochastic discount factor. So I guess that's a long answer to a short question, but I think it's a useful baseline to think about the expectations hypothesis. You do run into some of these documented puzzles in that case, and I think that opens up the opportunity to think about this a little bit more broadly, and I think there's still a lot of work to be done in that area.
There's a question. Nick, do you want to ask your question about corporate bonds?
Sure. So I guess my question was whether or not there was an established set of facts related to other assets. I'm thinking primarily about corporate bonds and how they respond to monetary policy surprises.
Yeah, good question. So Gertler and Karadi have some results on this, that corporate bond spreads respond to monetary policy. I think the measurement for corporate bonds, I think it's just a little bit more challenging than for stocks or Fed funds futures, because they don't trade all that often. So you have to be a lot more careful about high frequency results with corporate bonds, I think.
Thanks.
Okay, great. So then let's jump into this paper. So the question here is, why do markets move so much? We've already seen that stocks and bonds move substantially in response to monetary policy announcements. So the answer in this paper is to add time-varying risk premia to this basic new Keynesian model. And of course, the idea is to add these time-varying risk premia in a way that's somewhat disciplined. And so the way I'm going to add them is motivated by what we know about quarterly movements in stocks. So, as I mentioned, this is based on a habit model, but, if you don't particularly love habits, you can think about this as a reduction in the number of puzzles that are out there. So this tells you that if you take an established model that can explain the Shiller equity volatility puzzle, then you get the high frequency response of stocks to FOMC announcements for free. Or almost for free. Okay, so yeah, so formally I take the finance habits that I developed with John Campbell and Louis Becerra in our JPE paper, and I combine it with a baseline new Keynesian model of monetary policy. This model here focuses on the really the monetary policy equation, the monetary policy rule, and the shocks to it. So it doesn't have demand or supply shocks, but it's really focused on the monetary policy shocks. And then I show that, the large stock market responses to monetary policy announcements and the equity volatility puzzle are really two sides of the same coin. So we already looked at this. So as a results preview, what I find is that the model that is fit to the quarterly data naturally also explain the large stock responses on FOMC dates. How does this work? A higher short rate in this model depresses consumption. That's standard. That's just a new Keynesian model. But then on top of that, it also decreases the willingness to take risk, which thereby has persistent effects on risk premia. And that's just because risk premia always have a certain degree of persistence, and the persistence of risk premia at a quarterly, just in quarterly data, translates here to the persistence after FOMC surprises. The primary risk premia are quite large in this model. They're worth about 80% of the stock response, which is in line with decomposition that Bernanke and Kuttner did. I think it's also in line with your responses at the beginning of the class, right? I think 70% of you responded that the Fed moves markets because it affects financial conditions or sentiment, and that's I think what this model delivers here. Now, what's interesting, what's different here a little bit, what I can say on top of just the Fed moves risk aversion is that we can think of these movements in risk aversion as arising from the real effect on the economy. So in this model, the Fed does both. It moves cash flows, but these cash flow movements are not large. But what they do is they also induce a movement in risk-bearing capacity and therefore risk premia move. So the Fed moves financial markets, and it moves risk-bearing capacity because it has a real effect. And I think that makes sense, right? If the Fed didn't have any power to do anything for the economy, there would be no reason that it should move risk aversion or make anyone more or less willing to bear risk.
So two things. First, we have a question from the chat. Jinwei, do you want to ask a question?
Yes. So I was wondering that previous evidence were pretty much about the asset price reaction to monetary policy shock instead of more long-term variations in terms of asset prices and monetary policy spread, as in the Lovikson paper. So I wonder, what do you think of that relationship and that paper in general?
Yeah. So that's right. I don't. So the results that I've shown you are just about the short run response, but we do know that these responses tend to persist in the data. So the stock response is not just something that mean reverts right away. So the Bianchi, Letta, and Ludwigsen paper, I think it's a super cool paper. It's very intriguing. There, the idea is that precisely these changes changes in the monetary policy rule, gamma X might have changed over time, and that might show up in term premia in bonds. It might also change the stock market. I think it's very much a complementary channel that I like. I think the basic channel of the Fed moves the level of the economy and therefore it can change risk aversion. Still strikes me as very appealing and plausible, and it's probably there. But I think both of these things are probably going on.
Thank you.
And then the other question that I had is whether you could go a little bit into what is your model of risk-bearing capacity that makes this effect be there?
Yeah, of course, I will do that. Yes. Yeah, okay, so the literature we've already talked about. A lot of the literature, there are there are a bunch of really nice papers out there, and of course this doesn't stand in isolation. So we already talked about this Bianchi, Letta, and Ludwigsen, Bianchi, Ludwigsen, and Ma paper, which are more about regime changes. So there are regimes in monetary policy that change over time. and you might learn about those on FOMC dates. There's the Carolin and Pflueger paper, which in a way I think of as providing a different view of why risk aversion might change in response to monetary policy, and it's based on heterogeneous agents and their positions, how they change over time. I think there are papers out there, Chen and Kogan, for example, that argue that a heterogeneous agent model can look isomorphic to habits in many sense, and I'm open to that interpretation. I think the nice thing about the habit model that I use and that I show you is that we know very well how it looks for the standard stock market puzzles. So it has a good quantitative performance on a lot of things. And then it's a little bit easier to handle. So I can just look at a broader set of facts than if you're spend your energies thinking about the micro foundations of this. And then of course, there's Alexi's work, which is more focused on banks. I think that's also similarly, I think it's super nice to think about why might risk aversion change over time. My goal is to kind of unify a lot of the puzzles that we see out there, and I think slightly more, you could call it slightly more reduced form, but a habit model that we know how it works for the stock market, and we know it works how for the equity volatility puzzle is just quite useful. And then of course, there are models that have worked with long-run risks in monetary policy. So there are these papers by Ruderbush and Swanson and Gurion and Ng. Those are long-run risk models, and I think the nice thing here about a habit model is that a level in the interest rate can change risk aversion, and I don't need to make an auxiliary assumption of volatility goes up or volatility goes down with monetary policy. But in that sense, you could view it as something that might be applicable more broadly if you're willing to write down a model that has maybe constant risk aversion, but volatilities change with monetary policy. So, the main thing really is here, risk aversion goes up when bad stuff happens and you require higher risk premium. Okay, so then, what's the model here? And I won't repeat the monetary policy rule or the Phillips curve because we already saw them. What's different here is the model of preferences and risk aversion, which is what Pablo asked about. Right, so here let's repeat the Euler equation. So that's the same Euler equation as before, except that I write RT for the real risk-free rate. So that's IT minus expected inflation. Raising R depresses the output gap. Now, what I'm going to do here is I derive it from habit dynamics that combine kind of the macro side of habits, which is to lead to a hump-shaped and delayed output response to monetary policy, and the asset pricing side of habits, which gives you time-varying risk premium. Now, how does this work? If you have difference habit in the Campbell-Cochran tradition, it means that you derive utility not just over consumption, but consumption relative to habit. So if you're used to a particular style of living, or you're used to having particular set of things, we're used to having iPhones. If your consumption drops to a level where you can barely afford this standard of living, you become very risk averse over additional surprises. You really don't want to lose your iPhone, for example. And that means that the relative measure here, the relative state variable, is the surplus consumption ratio, which is the share of consumption that's available to generate utility. So it's consumption minus habit divided by consumption. And then the stochastic discount factor takes this form, which is a combination of, just the power utility stochastic discount factor. So it's curvature times the lowercase letters here stand for logs. So it's log consumption growth and log growth in surplus consumption. Now, how does the habit develop over time? One can write it in different ways, and the initial approach in this literature was to write habit directly in terms of lagged consumption, but that led to a number of problems, such as super volatile risk-free rates, which of course is a problem if we want to model a monetary policy rule. We have to have risk-free rates that are not too volatile and that can be described by a linear rule. So what I do here instead is write down a model for surplus consumption, which of course implies a model for habits. So this is following Campbell and Cochrane, and this is basically the specification also from my JPE paper, where we write down surplus consumption as following roughly an AR1 process. So theta naught is the mean reversion parameter here, and an important assumption here is that the innovations in surplus consumption are conditionally perfectly correlated with news about consumption. So the epsilon CT plus 1 here is the surprise in consumption. And this tells us that effectively habit ends up being a function of moments of consumption. So our habit depends on various moments of consumption, the implied habit. This lambda here is highly nonlinear, and it takes the same functional form as Campbell and Cochrane. It's downward sloping, which means that we get business cycle variation in risk premium. So when surplus consumption is low, that means that I end up being my SDF, my marginal utility, is much more sensitive to additional consumption use. So, ST being low, you can think of as, I'm getting close to my habit level. I get close to having to give up something that I got really used to. So then if I receive an additional consumption surprise, that really hits me. And the particular functional form in lambda is chosen such that this excessive volatility in the risk-free rate exactly cancels. What's new in this paper, so in the JPE paper, we added these terms related to the output gap and the lagged output gap. And what does that do? So what that does for the implied habit is it effectively gives you a hybrid between the way people have used habits in macro and the way people have used habits in finance. So it means that the implied habit loads more onto the most recent lag of consumption. And that means that you get this backward-looking term in the Euler equation. So your marginal utility ends up being more closely related to the change in consumption than just the level of consumption. What's different in this paper compared to my previous JPE paper with Campbell and Becerra is that this consumption innovation here is endogenous to the monetary shocks. And that's, of course, the interesting question here, because we're interested in monetary shocks. Okay, and then, sorry, I already talked about a bunch of this. So what we end up setting is theta 1 less than 0, theta 2 greater than 0, and that means that habit loads more on the most recent consumption realization. So then, how do we price assets? It's fairly simple. We take the stochastic discount factor that drops out of this habit specification, and if we price the risk-free rate, it gives us this asset pricing Euler equation. Bit of rearranging then gives exactly this log linear macro Euler equation, and the backward-looking terms are chosen to match the gradual output responses to monetary policy. So regarding Pablo's most recent question, last question, one important, so theta naught here determines the degree of mean reversion in risk premium. And Campbell and Cochrane picked this theta naught to match the what would you call it, just average degree of mean reversion and the price dividend ratio in the stock market. And so we just do the same thing here. That's where theta naught comes from. And this theta naught then basically pins down how quickly do risk premium mean revert after any shock, including a monetary policy shock. So that's how this is disciplined. Okay, and then how do we solve for stocks and bonds? So solving for stocks and bonds is a little bit tricky here, and I spend a lot of time trying to make this, really doing this properly. But in principle, it's actually not that complicated. So we can see this by pricing a 1-period 0 coupon consumption claim. So that's a claim that promises you to pay aggregate consumption next quarter, and then it becomes worthless. In that case, the expected excess return is just the co-movement, the covariance between the negative SDF and next period consumption. So it's gamma times 1 plus lambda times sigma c squared. Why does lambda show up here? Well, when lambda is high, the stochastic discount factor loads more strongly onto consumption use. That means the covariance between this asset with marginal utility is higher, and investors require a higher risk premium. So that tells you that because lambda is downward sloping, it means that you're going to have a higher risk premium on this 1 period zero consumption claim when surplus consumption is low. So if we receive bad consumption shocks and surplus is low, we require higher risk premium on consumption claims. How does this translate to bonds and stocks? Well, stocks in this model, I assume that they are a levered claim to all future consumption. So they're way more long-term than this simple 1 period zero coupon consumption claim, but otherwise they share a lot of the features. And then because these longer-term claims cannot be solved analytically, I have to employ numerical recursions, which I do following this methodology that Jessica Wachter refined in her 2005 paper.
Could you comment a little bit on the empirical relationship between a levered consumption claim and a dividend stream?
Yeah, so that's a good question. So, dividends are not equal to consumption, of course. And here I just use a consumption claim as something, stocks are an asset that generate more cash flows when the economy is doing well. They generate less cash flows when the economy is doing badly. I guess what you're probably, if I understand correctly, you're getting at this question of, are profits pro or counter-cyclical in new Keynesian models? And in this particular model, I agree that there is this tension here that if you have sticky prices, that means that in an expansion, firm profits actually fall. I see that more as a flaw of the standard new Keynesian model than something that's specifically going on here. I will also say that in the next paper, which I hope to get to, for this reason, I ended up switching to sticky wages, which really doesn't change any features of the model, but fixes this issue that dividends in that case end up being proportional to consumption. Then you can just call everything a claim to dividends. Does that answer the question?
Sort of, yeah. So I've seen a lot of people in finance approximate, the stream of dividends with a levered consumption claim, and as an empirical matter, I don't know how good that approximation is.
Yeah, dividends are not equal to consumption for sure. So you can, one thing that Campbell and Cochrane did was they actually had a whole section on, what if we model in addition dividends as something that's that looks kind of like consumption, is correlated with consumption in a plausible way, but is not equal. And for them, it didn't make a big difference. So I think, independent variation in dividends is not a huge concern here. And then if you're concerned about in the model, is consumption really equal to profits? In this model, it's not, but I have checked that you can modify the model to have sticky wages instead of sticky prices, and then it is. Okay, so, and then, how do I deal with these FOMC announcements, which of course are basically an infinitesimal interval relative to the quarterly frequency, which is the main frequency for the model. Basically, I say every quarter there's a vector of shocks. So this is the vector of quarterly shocks, and part of that shock is realized before the FOMC announcement, and then a small fraction is realized during the FOMC announcement. And I assume that these are independent. And then I solve for the FOMC stock return simply as the log change in the price at the full quarterly shock versus the shock that is known before the FOMC announcement. Okay, so this FOMC shock here is quite small, right? In the data, it's small. I calibrate it to be small in the model, but it's nonetheless quite interesting because it's the best. It's the most closely related, most Fed related news that we have, and it's a good way to test, do we have something that helps us think about how monetary policy relates to risk premia. Okay, so then, how do I calibrate the model? It's this title is is outdated. So it's actually a fairly simple calibration. So a lot of the parameters are set to standard values. The interesting parameters are these habit parameters, theta 1 and theta 2. I set them to match what we know from the empirical macro literature about how output responds to a monetary policy shock. So they're set exactly to generate a reasonable degree of backward lookingness in the Euler equation. The coefficients in the Euler equation add up to 1. That pins down one more parameter. This ends up being a model with only one shock. So, I can't match all the volatilities, but the important volatility, I think, in the model is the consumption volatility. So that one is matched at around 1.5%. And then the volatility of the news on FOMC dates is 6.5 basis points, which matches roughly the volatility of Fed funds futures in these 30-minute intervals around FOMC announcements. Okay, so here is kind of where do these habit parameters matter? This is the impulse response for consumption after a 1 standard deviation monetary policy shock for a different habit parameters. So if you set theta 1, if you set this habit parameter equal to 0, you see you get quite spiky, a very immediate consumption response, which mean reverts. Whereas if you have a higher theta 1, gives you more backward-looking Euler equation, you get a more hump-shaped response. And what's shown in red here are the empirical estimates from Cristiano, Eichenbaum, and Evans of what they estimated, how long does it take for consumption and output to respond to monetary policy shock, and how large is the response. So this tells you that we want a theta 1 of around minus 0.9 in order to match what's in the data there. So that's why we need the habit parameters on the macro side. Now on the finance side, what does this give us? So the model, the model generates a lot of, I think, appealing features for stocks, some also for bonds, and then for the macroeconomic dynamics. I just want to check that I'm not too far off. But basically, what the model does is it keeps the appealing features of Camel and Cochrane. So it doesn't destroy anything there, even though we have a much more structural model here of monetary policy in the background, right? Camel and Cochrane had just had IID consumption growth, so that doesn't allow you to ask anything about monetary policy. But so on asset prices, we have a equity premium, equity volatility, high Sharpe ratio. The price dividend ratio is fairly persistent in this model, which is from this theta naught parameter. How persistent is the surplus consumption ratio? Stock returns are predictable from the price dividend ratio in the model. The implications for nominal bonds, I will say, are very much dependent on the bond beta that's implied by this model. And hope to say more on that later. And then the volatility of consumption growth is roughly what we want it to be. The trough response of output to a 100 basis point Fed fund surprise is roughly what we want. And then also when this trough response occurs. Okay, so this is all quarterly. This is, quarterly model properties, low frequency. What does this mean for the implications for FOMC dates? So here, this table shows some of these empirical regressions, updated regressions of the Bernanke-Kuttner variety, how strongly this is the stock market on the left-hand side onto the Fed funds rate shock. So you see that here, say 25 basis point increase in the surprise increase in the Fed funds rate would tend to be associated by this, 75 basis point drop in the stock market. In the data, this is pretty symmetric. Positive and negative surprises act similarly. And if you control for the timing surprise, this magnitude becomes quite a bit larger, and you see that this 25 basis point increase in the surprise increase in the Fed funds rate would even be associated by more than a percentage point or 1.5 percentage point fall in the stock market. Now in the model, the model replicates that. The model generates a similarly large drop in the stock market after a surprise increase in the Fed funds rate. This is in the model, it's also fairly symmetric. There's no particular asymmetry. And sometimes people think that, because this model has risk aversion going up after bad news, that you would need to, that this would imply something asymmetric, but it doesn't, because surplus consumption is continuous, it's not kinked. So this tells us that, so this also matches between the model and the data. And then what the model allows me to do is a decomposition. If you do the risk neutral stock return, which is holding risk premium constant, you get a decline in the stock market after a surprise increase in interest rates, but this decline is much smaller. And the largest part is driven by these time varying risk premia, because because investors after bad news, they require higher risk premiums, so they're not willing to pay as much for stocks. So this is was we started working on this and just tried it, and it kind of dropped out, and we thought, okay, this is this is kind of cool. Okay, so what's the mechanism? Let's have a look at the impulse responses. So the top three panels here are the macro impulse responses that I already showed you. So this is the nominal rate, it goes up, it mean reverts. The output gap, it drops, it mean reverts, and inflation, which goes down. Now, what happens to stocks? So the risk stock equities fall, and a good portion of that is the risk, risk neutral, because output falls, and therefore the consumption falls. Therefore, stocks just represent a claim to something that's less valuable. But on top of that, this risk premium is large, and taking it together, we get this overall fall in the stock price. Nominal bond yields, as you can see here, they go up, and the risk neutral part reflects, the red dashed line here reflects that we just expect a higher policy rate going forward, so nominal rates go up. But there is actually also a quite substantial risk premium component here, and that's because in this calibration which only has monetary policy shocks, nominal bonds are somewhat risky, so that when there's bad news about output and consumption, investors become more risk averse, and therefore they also require a higher return on nominal bonds. And so nominal bond yields go up more because people think they're risky, and they're not willing to pay as much for them. They require a higher return, and even more so for real bonds.
So, Carolin, we have a question from the chat. Manuel, do you want to ask it?
Sure. Sorry to slow you down. But in the previous slide, what was the definition for the timing control?
Thanks. Yeah, thanks for stopping me here. Thanks for asking. So the timing control is just exactly as in Bernanke and Kuttner, which is the difference between the change in the 3-month Fed funds futures minus the change in the immediate Fed funds futures. I know there are way more sophisticated ways of doing this. I just wanted to keep things simple here. Any other questions?
So I have a question about bond premia. So I can see how in a model where the only shock is monetary policy shock, like when interest rates go up, it's a bad sign. So that gives you the correlation that high interest rates are bad times, and therefore the premium. Mm-hmm. How does that sort of extend it when you have a lot of shocks that give you different correlations?
Yeah, that's a great question. And so if you have a lot of shocks, and say you have demand shocks maybe that are dominant, and these monetary policy shocks are just kind of small but nicely identified, you might have nominal bonds with a negative beta. And that's precisely what we've seen in the data since 2000. And that might change the risk premium response. That might change it. So I really view this stock response as the main result of this paper. The bond response, I think, requires a little more work to fully understand what's going on. I find the Bianchi, Letter, and Ludwigsen channel that Michael and I also looked at in our empirical paper quite appealing, which is that you might in fact learn about something that drives bond betas on these FOMC days. You might learn about gamma X or something like that, which then in turn also moves risk premium. So I think one thing that does, I do take away from here, which is that these risk premia can be substantial in magnitude. But exactly how they work, I think, I think this is overly simplified here, and I really like I think of this really as a paper about stocks more than bonds. Does that make sense?
Yep.
Yeah. Okay. Okay. Perfect. So, for example, what the model also generates is it generates more facts than just this aggregate stock response. So, if I look at the cross section, which we saw in the Bernanke-Kuttner paper, the model generates that, and the reason is that risk premia, say if you have these are the more utility type stocks that have a low beta, they respond less. The model predicts that their risk premia are lower, and their risk premia are going to move less in response to monetary policy shocks. So they should have a lower response coefficient to monetary policy surprises, and that's exactly what we see in the data. So the model catches this result of Bernanke-Kuttner for the cross section of industries very easily. There are also implications in the model by what the current level of risk aversion is. So, for example, we can so this is what I'm showing you here is the same headline coefficient that we saw in the table. This is the regression of stock returns onto the monetary policy surprise. But we split our simulated sample into deciles by surplus consumption. So the more risk-averse states of the world are on the left, and the less risk-averse states of the world are on the right. And so what the model predicts is that if you're in a less risk-averse state of the world, the aggregate stock market should respond much less to the same monetary policy surprise, whereas if you're in a high risk aversion state of the world, the stocks should respond a lot more to the same monetary policy surprise. And that's something that you can also see to some extent in the data. So this is a regression in the data. Stock market returns onto the Fed funds rate shock, and Fed funds rate shock interacted with here I use the VIX, risk aversion above median, and you see that this interaction also enters quite negatively and significantly. The cross-section of stocks also helps to show this clearly. So, for example, if you look at the high beta stocks, this is particularly clear, the ones where risk premia really should matter most. In high risk aversion states, their stocks respond more to monetary policy surprises in a way that's similar to the model. So there's an implication for kind of state contingency. So these are the implications for bond yields that probably you already asked about. And here I replicate some of these results that people have produced in the literature. Now, the different types of monetary policy surprises that you use on the right-hand side actually matter quite a bit for how strongly bond yields, long-term bond yields respond. So here's, if we just use the immediate Fed funds surprise, nominal bond yields actually don't respond that strongly. It's just a coefficient of 0.04. So that means that a 100 basis point increase in the immediate Fed funds rate is only associated with a 4 basis point increase in the 10-year nominal bond rate. The real bond yield increases more strongly, about 26 basis points, and then break even, which is the difference between the two falls. If you use a slightly longer term measure of monetary policy surprises, so 3-month Fed funds futures, you get larger coefficients with a 25 basis point increase in the nominal rate and a 39 basis point increase in the real yield. And the model does, if you look here what the model generates bond yield responses within that ballpark, and a good portion of that is risk premium. But then if you run the Nakamura-Stenson result, and they use a slightly longer term measure of monetary policy surprises, they look at changes in euro dollars with a maturity of up to 12 months around FOMC announcements. Then you get these really large coefficients of how strongly nominal and real bond yields respond to the monetary policy surprise. And there's definitely a gap here between what's in the data and the model. So, I think the bond risk premium responses in this model can be sizable, but they do not fully close the puzzle for longer horizon monetary policy shocks, and they're also going to be dependent. They're going to be conditional on the what the beta is of bonds in this equilibrium. And so I think that's something that I'm quite interested in. I think that's something that still can, there's more work to be done here. Okay, so I'll conclude here. So, what I want you to take away here is that I think these identified monetary policy shocks, even if they are rare and small, they're useful because they are a basic building block of monetary policy, and people in applied in empirical macro have used them to trace out how monetary policy works. And so similarly, I think they can be useful for testing this model. I want to think of it as a proof of concept model of, can we model monetary policy risk premia and link them to standard asset pricing facts? So this model generates a couple of things. It jointly generates high quarterly stock return volatility, risk-free rate dynamics, and large stock responses to monetary policy news. And I think it's fairly successful at explaining a broad range of asset price responses to monetary policy surprises on FOMC dates, with really minimal deviations from the basic new Keynesian model. And of course, it doesn't explain everything, but I think just like for the number of ingredients that I've added here relative to the your textbook model, I think it really generates I found a surprising and very, very interesting amount of very, very interesting number of results of what we know is in the data. Okay, so that's that's this paper here. Any questions at this moment?
Can I ask a question, Carolin? So, so in a nutshell, could I summarize the mechanism of this model as saying that a contractionary monetary policy shock lowers expectations of future output, and that has a big effect on the surplus consumption ratio, and that affects the stochastic discount factor and lowers basically the equity risk premium right away?
Exactly, yes.
And so then, but if there were big information effects and like a contractionary surprise would lead to upward revisions of future growth expectations, then that would work the other way. I mean, so maybe yes. Indirectly, yes. I mean, I guess there's no information effects here, and information effects kind of would work against that.
Exactly, yeah. Yeah, I played around with information effects in this model at some point, where, the way I modeled it was that you receive news about the growth of potential output. And you're absolutely right. If you receive good news about the growth rate of future potential output, this is going to raise consumption and output right away, because if I expect that I'm going to be super rich in the future, then I also want to consume more. So it's good. So high, good news about the growth rate is also good news today. So then consumption is further away from habit. I become less risk averse, and the stock market would rise. So you're absolutely right. So good news in this model, good news is also good news for the stock market, and it gets amplified through risk premium. All right, so then maybe let me just highlight the problem set, because it's really about about this paper, and I'm quite excited to to share this, because I've been with my fantastic RA, Luis, we've put in quite a lot of effort to clean up. You always post your code, but some code is easier to use than others. So we've put in quite a lot of effort to make this easier to use. And this is very much still a beta version. So if you have comments and questions, please just let us know, and we'll be very happy to hear from you. So the way you can find it is, the code is here. See, there's a link here. You can click on it, and also post it in the chat. So this is here, and then what the problem set asks you to do is run the main file, which replicates the main results from the paper. So just, you should just be, the way it should work is you should be able to just open this file, hit run, and it should really produce most of the results from the paper. And then, what this code does is it gives you a lot of the outputs and you can play with them. So one simple thing that I'm asking you to do is to plot the impulse responses, the ones that I showed you twice already, for output gap, inflation, and the policy rate. And then on top of that, which is not shown in the paper, you can also plot the surplus consumption ratio. And so that shows you basically how does the surplus consumption ratio directly respond to this shock. Now then it asks you to elaborate which state variable do you think is responsible for the persistent risk premium response to a monetary policy shock that's shown in the paper. And so you may want to give you here some hints. So this is all stored in a class. So you want to look at asset.irf3, and then you can here's a hint on how you can speed up the code, because these impulse responses, if you're doing it properly, you want to simulate them many times and average. But in order to just get a sense of what's going on, you don't really need to do these simulations. So this shows you how to switch off the simulation so everything works faster. And then question 4 asks you to just do a very simple comparative static, which is to change the monetary policy output weight, and then see what you find and explain what you find. So yeah, so have a look at the problem set, and please do email us your solutions. And if you send us your solution, you'll get the solution first, and then eventually we'll make the solutions to the problem set public. But just as a small incentive to actually submit your solutions, we'll send you the solutions faster if you hand something in.
We'll also send you a gold star and a fake
gold star, exactly. You'll get a gold star and you'll get the solution to the problem set.
So we have one more question from the chat.
Hi, I just want to make sure I was reading figure 5 correctly. Is it suggesting a time varying impact of monetary policy on stock markets, in particular that a unit of monetary policy surprise would be much more effective on stock markets in bad times versus good times?
Exactly. Yeah. I mean, you're absolutely right. I would use the word effective because, what's the Fed's objective? The Fed mandate is inflation and unemployment. It's not the stock market. But you're absolutely right. The prediction is that in bad times, and especially when people are risk averse, which, could also have somewhat broader reasons, you should expect to see a much stronger stock market response to the same monetary policy surprise. Now, in terms of monetary policy effectiveness, I would turn it around and almost argue that if you see a large stock response in bad times, it doesn't mean that monetary policy is more effective. You might have the same, ability to mitigate a recession, but the stock market is just going to respond much more strongly because the whole ability and willingness to bear risk changes much more strongly. Does that make sense?
Yeah, thank you.
All right, so I'm going to suggest that we take a 5-minute break and then continue after that. How about that?
Thank you. Perfect.
Okay. So let's reconvene at 8:40. Well, I guess 8:40 California time, 11:40 East Coast time.
I guess Carolin's not back yet.
Okay, let's wait for her. Is
One
the live
second.
streaming back on?
1 second. Okay.
All right, all yours.
Okay, perfect. I can't see the participants right now. Can't see you now. Perfect. All right. Thanks for sticking around. Thanks for coming back. So what I want to talk about now is some ongoing work that I have that's building on the same framework, but also asking a different question, which is what do we learn? What can we learn from Treasury bond risks? It's entitled Back to the 1980s or Not, the Drivers of Inflation and Real Risks in Treasury Bonds. Okay, so the idea is that it's useful to understand what what are the fundamentals driving risks in Treasury bonds. As already discussed, bonds and stocks are linked to the inflation and the economy, and as such, they are potentially useful as real-time indicators for, for classic questions in monetary economics. In fact, I remember the first time I presented the other paper that we just talked about, the JFE paper. The first time I gave an early talk about this at the Dallas Fed. That happened to be the date when the Fed ended up had a surprise easing in interest rates just before COVID, and I can promise you, no one was listening to me, and everyone was following the stock market. So, bonds and stocks are useful, and they are followed as real-time indicators. Now, but there are also these hugely time-varying risk premia, and therefore it's not quite as simple to just translate from bonds and stocks to the economy. The particular moment that I'm interested in this paper here is the beta of bonds. Why beta? Well, if you think about risk, what makes a risky asset? Well, a risky asset in a classic CAPM sense is something that co-moves with the market portfolio, which is often taken to be the stock market. And it turns out that the betas of nominal bonds turned from strongly positive during the tumultuous 1980s to negative during the 2000s, and then they change again. So if you listen to NPR radio shows or whatever, there's sometimes talk about the bond market has never been as volatile since the 1980s. So I think there's a serious question of are bond markets going back to the 1980s, and is the economy going back to the 1980s, and how are these related? So the question here is, what do these changing bond stock betas tell us about supply versus demand shocks and monetary policy when risk premia are also time varying? So this is, and so when I work through this, the conclusion that I end up with is that bond stock betas are really can have a lot of features of a real-time indicator of the Fed's ability to engineer a soft landing from adverse supply shocks. So to the extent that markets anticipate a soft landing, this should be reflected in bonds having negative betas, being relatively safe, and so on, which is actually what markets have been pricing in for throughout this recent inflation bout. Okay, so here's why do these bond stock correlations matter? They're certainly very prominent in policies. So, for example, if you look at the economic report of the president from this year, the one financial market indicator it really talks about is the co-movement of bonds and stocks. And it speculates, well, maybe the bond stock correlation changed because markets anticipated monetary actions. The sign of this correlation suggests that negative supply shocks were important for US financial markets in 2022. Isabel Schnabel from the ECB Executive Board also has looked at a very similar moment and has concluded that it tells us something about demand side factors driving inflation. So I think the question of, and of course this is all a little bit kind of heuristic, intuitive. So I think we really need a more formal model to think about supply versus demand. Does that drive bond stock betas? To what extent does monetary policy matter? And to what extent does flight to safety or time-varying risk premium, to what extent is that also something that affects bond stock correlations? And that's what I want to do here. So we don't want to go back to the 1980s. Here's the data. These are nominal and real bond risks. This is the red here is the nominal bond beta for a 10-year Treasury bond. I estimate that as a rolling regression coefficient of these are bond excess returns onto stock returns, use quarterly returns and 5-year rolling windows. What you see here in red is that bonds had this positive beta during the 1980s and even 1990s, meaning that whenever the stock market fell, bonds also fell. by partialing out the role of inflation index bonds, so these are bonds that don't suffer from inflation, we can see that a good portion of this positive bond beta was indeed inflation. So this makes sense, right? This was a period when high inflation, which is bad for bonds, was also bad for the economy. So if you have high inflation going along with recessions, well, high inflation is bad for bonds, recession is bad for stocks, so then bonds and stocks could move up and down together. This changed markedly after 2000. So this red line changes sign, becomes negative. Bonds had a negative beta. The inflation index bonds also changed, but much less so. Now, of course, these two lines also became narrower. This makes sense. Inflation was much less volatile, wasn't as important in the 2000s. And when inflation did happen, it was of the good, quote unquote, good variety, meaning that when inflation went up, say after the financial crisis of 08-09, this was generally good economic news. So higher inflation is bad for bonds, but good economic news is good for stocks. So then bonds fall just as stocks go up, and you get a negative bond stock beta. And then here, this is post-COVID. So what we see here is, when I started looking at this, I was very, very pessimistic about inflation. This was, middle of 2022, inflation was whatever it was, 7%. I thought I was fully anticipating to see a return to the 1980s here, but it's not that clear, right? So the red line here, the nominal bond beta for this sample has remained negative. The inflation index bond beta has changed a bit. It's gone up a little bit. But so this last period has some features of the 2000s in the sense that nominal bond betas are negative. And it has some features of the 1980s in the sense that real bond betas have gone up. But it's not as simple as in the data here as a straight return to the 1980s.
Can I ask, Carolin, is this a moving average over what horizon?
5 years. This is 5 years.
Could it be that that's just too long to detect if it did flip? Oh, you're about to change it.
Yes, exactly. So, the nice thing about bond betas is that you can do this at higher frequencies, right? So this is using daily data over 6-month rolling windows. And you see something similar here, which is that the nominal bond beta post-pandemic has increased a bit, but it remained below 0. And so and at the same time, the inflation index bond beta has gone up, has gone more above 0 than the nominal bond beta. So here I will also say I'm cutting the sample in July 2022, which is when monetary policy changed substantially. So here, this was the period of big inflation. Inflation really started here, and nominal bond betas remained negative, but real bond betas went up. And then after July 2022, actually, I think monetary policy did change. This was when the Fed started doing these 75 basis point interest rate hikes. But at that point, both the nominal and the real bond betas go up together, and the inflation component still stays around 0 or maybe negative. So to the extent that bond betas have gone up, this time it's in the real bonds and not in the nominal bonds, which is quite different from the 1980s. Okay, so what does this mean? What I'm interested here is really modeling the interaction of supply and demand shocks with monetary policy. So, it's also in terms of, how does this relate to my own prior work? The JPE paper with Carolin Pflueger didn't have supply and demand shocks. The JFE paper with Gianluca Rinaldi didn't have supply and demand shocks. So this is what I'm interested in here, really supply and demand. And I find that this interacts in an interesting way with monetary policy. So in short, what I think is different now from the 1980s is not so much the shocks, but the policy response. Okay, so as a roadmap, what I want to show is, first of all, a new Keynesian model with supply and demand shocks and endogenously time-varying risk premia via habit formation preferences. So this builds, of course, on the model that we already saw, but it adds supply and demand shocks. And I calibrated differently. I calibrated twice. I calibrated once to the 1980s, which has volatile supply shocks and a fast inflation-focused monetary policy rule. This implies the positive nominal bond betas that you also see in the data for this period. And then there's the 2000s calibration, which has volatile demand shocks and an inertial, so more slowly moving, and a more output-focused monetary policy rule. And that implies the negative nominal bond betas that we also see in the data for this period. So I view this as kind of, test driving this model. Does this generate for the, these macroeconomic changes from the 1980s to the 2000s are, of course, subject to a large literature. They've been understood fairly well. Does this generate plausible implications for bond risks? And the answer is it does. Now then, having this model, I can do the interesting part. I can run a series of counterfactuals. The first counterfactual is that if I combine shocks similar to the 1980s with a 2000 style monetary policy rule, I get the model generates a negative nominal bond stock beta, but increasing real bond stock betas, which is intriguingly close to the features that we see in the post-pandemic data. So this combination of supply shocks, but a more inertial output-focused rule ends up looking fairly similar to what bond betas have looked like recently. Then I can do a decomposition of, which shocks is it prevalent versus realized shocks that are reflected in bond stock betas, right? You might wonder, if I look at a bond stock beta, does this just tell me that we just experienced a couple of supply shocks and just realized shocks, or does it tell us something about what investors are expecting and pricing in? And it turns out that in this model, it's really about the prevalent shocks that are priced in, not so much about the realized shocks. And
by that, you mean there's a shock generating process, and that's what matters more than the realizations? Is that what prevalent means?
Yes, exactly. Yes, exactly. So if I solve the equilibrium, so I have the 1980s equilibrium, and I feed in, say, 2000 style shocks just as realized shocks, but I don't resolve for the equilibrium, I get bond stock betas that look like the 1980s and not like the 2000s. Yeah. And then, exactly what part of monetary policy is it that keeps nominal bond betas negative even when there are supply shocks? Well, it turns out there are two possibilities in the model. Either a monetary policy that really doesn't care about inflation, has a low long-term inflation rate, is gonna keep nominal bond betas negative, which of course would be pretty bad news if we observe negative nominal bond betas, and then we would have to infer that the Fed has given up on its inflation target. I really hope that that's not the case. Or the other alternative is that investors simply perceive that monetary policy will counteract inflation, but it's just going to do so more slowly with a greater inertia coefficient, basically moving interest rates more gradually over time, and then eventually counteracting inflation. And yeah, and then, to what extent does it matter? Does the expectations formation process for inflation, is that reflected in bond risks? Right, that's also a big discussion in terms of how long is inflation going to last, and is high inflation getting entrenched because households and wage setters' expectations are moving up and everyone's expecting higher wage increases. So it turns out that this sort of behavior can be modeled fairly easily. It ends up showing up just through a more backward-looking Phillips curve in this model. And what I find is that a more backward-looking Phillips curve is something that is linked to the predictability of bond excess returns, which, of course, in asset pricing we've known for a long time is there. So we know from Campbell and Schiller that bond excess returns are predictable from the yield spread. And what this model can tell you is that a backward-looking Phillips curve, adaptive inflation expectations formation, is important to model to explain this feature. Backward-looking inflation expectations in this model are not so much linked to the bond stock beta. So the bond stock beta is informative about a bunch of things, but it's not so informative about the persistence of inflation necessarily, which I think is also important to point out. Kind of what can you learn from these bond stock betas, and what is it that you cannot learn, where you have to look maybe at a different aspect of bond risks, and in particular this predictability of bond excess returns.
But one question about these backward-looking expectations. So when you solve the model with these expectations, the idea is people form these expectations, they're not quite rational, and those expectations inform like all their opinions about asset prices, everything. Is that how it works?
Yeah, good question. So what I ended up doing is I ended up separating it in the sense that only the wage setters have these somewhat backward-looking expectations, not the asset prices. That's also something that Bianchi and Ludwigsen did, in the sense that, you know, the asset prices are maybe a little bit faster than the agents in the real economy. So the adaptive inflation expectations only affect the then translate into just moving inflation dynamics, but not how things are priced.
I see. Do you know if it makes a difference?
So difference for what? So if you were to say the asset prices also have more backward-looking expectations about inflation. I suspect it, you know, I'm speculating here. I suspect it would affect the magnitudes of how strongly a cost push shock gets priced into bond betas, but I would be very surprised if it affects the sign of how things work. Yeah. I mean, the reason I didn't look into it too much more was basically because I found that these backward-looking inflation expectations didn't, you know, they just affect this predictability, but not the betas to a huge degree. So then, you know, I decided to stop there. Okay, so here's the model, and I will try to, you know, I know we already talked about a bunch of this, so I'll be a little bit quick here. So the oil equation is the same as before, but now we're interested in this demand shock. The Phillips curve is here. We're interested in this cost push shock, and then there's the monetary policy war. Same preferences as before, habit formation preferences, which give the exactly log linear Euler equation and time varying risk premium in bonds and stocks. Now, the supply and the demand shocks and their asset pricing implications are new relative to this, relative to our JPE paper and the JFE paper, why does the Fed move market so much paper that we previously talked about. Right, so if I had to delineate where does the previous paper end, where does this paper start? The previous paper was about VIT, the monetary policy shock. This paper is about the demand and the supply shocks, and then of course I also look at different outcome variables, spot stock betas. Okay, so what about preferences? Preferences, you know, I'll skip the supply side. It's a little bit, I played around with it a little bit relative to the previous paper, but you know, nothing too different. Preference and asset prices. So how are stocks priced here? So same preferences as before, also calibrated as in the JFE paper, meaning that it matches the output and consumption response to monetary policy shock in the data. Stochastic discount factor is still this object that depends on log consumption growth or log growth in surplus consumption. And then stocks are priced basically through these asset pricing recursions for zero coupon consumption claims. And in this model, actually, consumption is proportional to firm profits. So you can also view stocks simply as a levered claim on firm profits, which might be more appealing. Now, what about bonds? So for bonds, I introduce an additional shock and a bond preference shock, which is similar to a safety shock that has been very successful in international finance. And this means that here, this additional shock C enters as a wedge in all the bond asset pricing recursions. There are different ways of microfounding it. And for me, it doesn't really matter too much where it comes from. You can think about it as either time-varying intermediary constraints, right? If I'm a household pricing bonds, I don't quite have access to the government bond market. There's probably a markup that I have to pay, and that might vary over time. Or you could think of it as potentially changing expectations of growth. They might not even be quite rational. So if I'm expecting super high consumption growth going forward, that's also going to similarly drive down the price that I'm willing to pay for a bond in order to transfer consumption into the future at a given process for realized consumption and surplus consumption that enter into this stochastic discount factor. So I think this is a shock that has more and more support, is more and more normal across various parts in the literature. And the reason it's useful for me here is that it gives me a demand shock in the Euler equation, which we didn't have before. So here's the asset pricing equation for the 1 period risk-free bond. Substituting in for the stochastic discount factor and rearranging gives an exactly log linear consumption Euler equation. So we have the output gap linked to expected output gap, lagged output gap, and the real rate. And then there's this demand shock here, which arises from this bond preference shock. So when C is positive, this means that households really don't want to hold government bonds. And that's going to increase consumption and output because they're not buying bonds as much. So that's where the demand, that's this demand shock that drives a wedge between consumption and output relative to the risk-free rate. Okay, so how is this model calibrated? So the calibration strategy here is effectively a simulated method of moments, but there are a couple of parameters that I fix ex ante. The sample period is chosen to match the period when the inflation output correlation changed. So prior to 2000, recessions generally meant high inflation. After 2000, recessions generally meant low inflation. So that's how this break date is chosen. So a couple of parameters are constant, the preference parameters are constant, and the Phillips curve slope is from this recent paper by Hazaravain and Nakamura and Steinson. Then what I do is for each period, I minimize an objective function that minimizes the distance between 12 or 13 model moments relative to the corresponding data moments. And then so that gives me the volatilities of the demand, so cost push and monetary policy shocks, and it gives me the monetary policy rule parameters. And then finally, the backward-looking inflation expectations are a little bit harder to pin down because they require solving for asset prices, which is slow. So I do that in a separate step, and I do this to match this Campbell-Schiller bond excess return predictability. So that's a place where asset prices do enter into the calibration. Okay, so here are some of the moments that I match, and I think this is the most interesting one. So for the so here what you see is the regression coefficients of output gap onto inflation, lagged inflation, and I do this at various horizons. So this is kind of like a Jordan type local projection. But it's really just a regression, and the important thing is I run the same thing in the model and in the data. And here's what you see for the 1980s. So higher inflation tends to go along with a decline in the output gap. So the dashed line here is the data. For the 2000s, higher inflation tends to go along with an increase in the output gap. And it's useful to look at these various lead-lag horizons here because as you see for the 1980s, this thing of stagflation, this is the stagflation. Inflation is high and output is low. This is actually most evident if you allow for a little bit of a lag between inflation and output, and that's why I think it's useful to look at these lead-lag relationships. And this makes sense, inflation first goes up and then you get the recession. What this moment pins down in the model is that I need volatile supply shocks for the 1980s calibration. Conversely, for the 2000s, the opposite relationship holds, and what this forces in the model is very small supply shocks, so mostly monetary policy and demand shocks for the 2000s calibration. So this is just one moment. I do similar moments also for the output gap interest rate relationship and interest rate inflation relationship. What this gives me is basically, I think, very intuitive changes in the macroeconomy from the 1980s to the 2000s. So it gives me an economy dominated by volatile cost-push shocks, supply shocks in the 1980s, also volatile monetary policy shocks, which makes sense. You know, there were a couple of very large movements in interest rates. And then for the 2000s, mostly volatile demand shocks, which also makes sense because, you know, you had the dot-com crash in 2000, you had the financial crisis of 2008, 2009. All of these, you know, you can interpret as something like a demand shock where consumption fell even though interest rates weren't going up as much. And there were other forces that led to a decline in consumption and output. What about the change in monetary policy? The change in monetary policy, I think, is also intuitive. So we're moving between in the 80s, we have a monetary policy rule with an inflation coefficient that was quite large, 1.35. A lower output coefficient 0.5, and then monetary policy inertia of around 0.5. So this is actually fairly close to the original Taylor rule. Then for the 2000s, it changes. We have a lower weight on inflation, higher weight on output, and also much more inertia, meaning that you know, when things change, that the current interest rate is just much more closely linked to the past interest rate. Okay. And then so this adaptive inflation expectations parameter, what this is picked to match is the Campbell-Shiller coefficient in the data. So this is, you know, if you quarterly bond excess returns onto the lagged yield spread, it's well known that this generates a positive coefficient in the data when 10-year yields are higher than the 1-year yield. On average, you tend to earn more by holding a 10-year bond. And in the data, this is the fat dashed line. In the model, this is something that depends. This is for the 1980s calibration. Something depends on how backward-looking are these, how adaptive are these inflation expectations, and how backward-looking is the Phillips curve. So for the 1980s, this leads me to pick a backward-looking adaptive inflation expectations parameter of 0.6. For the 2000s, there's actually not as much, there's not much evidence of this bond return predictability in the data, and in the model, it also, there isn't much there. So I pick an adaptiveness parameter of 0, meaning rational inflation expectations, which also does best on the macro side. I think this is not crazy. I tried running some Pflueger-Gorynichenko inflation forecast error regressions by sub-period, which also, which I align with this interpretation of more rational inflation expectations over time. Okay, so what does this model mean for asset prices? On stocks, there's really, it's very similar to what we already saw for the previous paper. High equity premium, volatile stock returns, equity Sharpe ratio, a persistent price dividend ratio, and stock returns that are predictable from the past price dividend ratio. So far so good. The more interesting part is for bonds, because now we have exactly what Pablo asked about, which is, if you change the shocks in the background, the beta of bonds is going to change. And so here we see that for the 1980s, this model implies volatile bond returns with a positive beta for the nominal bonds, slightly just only slightly positive beta for the real bonds, and then also this bond excess return predictability, which was of course explicitly targeted in the calibration. For the 2000s, this flips. The model implies a negative nominal bond beta, negative real bond beta. That's actually not too far from the nominal one. And it also implies very little bond return predictability and much less volatile bond returns. So there's a lot, of course, I don't match everything here by, up to 3-4 basis points, because this model doesn't have that many parameters, doesn't have that many additional, intentionally keep it somewhat simple. But I think, given that this is something that matches the macro dynamics from the 1980s to the 2000s and how we think it has changed, it's actually it's actually very, very good at capturing also a lot of these changes in bond risks. So any questions here? Okay. Perfect. So then, let's move to the interesting part, the counterfactuals. So is it supply versus demand, as in the or is it monetary policy, which the economic report of the president seemed to think? What can you read off from these bond stock betas? So if we start from the 1980s calibration, which implies these very strongly positive nominal betas and slightly positive real betas, and we change some parameters to the to an average over these two calibrations. If we change the shock volatilities, you can see this has a huge impact on the nominal bond betas. They basically shrink to zero, and leaving the monetary policy rule at the 1980s calibration. Similarly, if we change the monetary policy rule but leave the shocks at the 1980s calibration, the nominal bond beta also changes a lot, and it even becomes negative. So nominal bond betas change either with shocks or monetary policy if we start from the 1980s. Okay, conversely, if we start in the 2000s, which has, the 2000s have these negative nominal bond betas, negative real bond betas, similarly to what we saw pre-pandemic in the data, then if I change the shock volatilities towards the 1980s, or I change the monetary policy rule to the 1980s, very little changes. And so when I first saw this, I thought, hang on, there must be something wrong here. This is weird. But then I realized, look, this is actually really interesting, and it makes a lot of sense. Because what's going on here is that positive bond betas are harder to generate than one might think. And they only arise if supply shocks and the 1980s style monetary policy work together. So this is similar to what was argued in response to these oil shocks in the 70s and 80s, and Bernanke Gertler had a paper about this. The monetary policy response to these cost push shocks is very important for whether or not you get a recession, and therefore it's very important for stagflations and what's priced in bond stock betas. So it's really, if you imagine like a 2x2 matrix, 1980s shocks, non-1980s shocks, 1980s monetary policy, 2000s monetary policy, it's really only the quadrant that has the 1980s style shocks and the 1980s style monetary policy with this huge inflation weight and a fast response that will give you positive bond stock betas, positive nominal bond stock betas. Okay, so what's the mechanism here? In order to understand the mechanism, I think it's very useful to look at the impulse responses to a supply shock. If we start with the 1980s calibration, a supply shock, this is the cost push shock in the Phillips curve, it's always going to drive up inflation. So inflation goes up. And the policy rate in the 1980s calibration goes up, and you get a recession. So this is exactly the stagflation, bad inflation, right? Inflation goes up and you get a deep recession. Now in the 2000s calibration, it looks quite different. Inflation still goes up. But the policy rate goes up more slowly, and as a result, the real rate falls at first. And because the real rate falls at first, you get a very different economic response, kind of this S-shaped wiggle here, which it's not a perfect soft landing. You still get a recession eventually, but it's much closer to a soft landing than in the 1980s calibration. So the more patient monetary policy response here ends up. Of course, it's a trade-off between how much inflation are you willing to accept in exchange for economic output. But yeah, so it really alters the economic response here. So that's exactly this interaction between monetary policy and the nature of shocks. Yeah.
It's a little bit surprising that if you look at the difference in the policy rate responses, they don't look that different, and yet the output gap response is quite different. Could you explain that?
Yeah, I mean, I think it's really the real rate that matters, and so you also see a steeper inflation increase here. So if you put that together, it's really a significantly different real rate response. Yeah, so this is just the standard New Keynesian model, nothing about risk premium here. So this is something that is really, it can be generated from very, very simple code. The more interesting part is for me, what happens to bond stock pool movements. And it turns out, this different economic response, different output response to a supply shock translates into different bond stock pool movements. So here what you see is the same supply shock. It's going to drive up nominal bond yields, both the risk neutral yields, and then once you account for risk premium. So bonds fall in response to this inflationary shock. But what happens to stocks differs, and it differs across these two calibrations. For the 1980s, and this is the stock dividend yield, so this is inversely related to stock prices. Bond yields are inversely related to bond prices. So what this tells you here that these two black lines move together, therefore stocks and bonds. So bonds and stocks are positively correlated in response to a supply shock after in the 1980s calibration. Now,
but do you have what happens to dividends themselves?
Dividends, I mean, they move very much like output here. Yeah.
Okay.
Okay, so yeah, so here you see that for this reason, the supply shock generates a strongly positive bond stock beta in the 1980s, but not so much for the 2000s. And for the 2000s, you know, the other shocks, the demand shock in particular, gets to dominate the bond stock beta. So you get a negative bond stock pool movement for the 2000s. There is actually something very interesting about risk premia here. The risk premia are particularly interesting after the demand and the monetary policy shocks. And you can see that if you compare the risk neutral yield here and the overall total yield, which includes time varying risk premia, there's a huge difference here, right? They're not the same. That tells you that risk premia do have an important effect here. And what's happening here? This is precisely you know, where the equilibrium matters. So if you, for example, if you look at the 1980s calibration here, let's imagine, you know, we're rolling along. It's the 1980s. Everyone's pricing an inflation risk premium into bonds, and now there's a big demand shock. We don't think it's ever going to happen again, but it just happened. Then you know, stocks are going to fall. And the stock dividend yield is going to fall. Stock prices go up because we're less risk averse. And because we're less risk averse, we're also much more willing to pay for nominal bonds because we view them as an asset that's similar to stocks that's risky in equilibrium. So nominal bond yields after positive demand shock in the 1980s, the risk neutral nominal bond yield should go up because inflation went up. So in expectation, if you just base it on cash flow expectations, nominal bond yields should go up. But because we're so much less risk averse, nominal bond yields may actually fall. And bonds and stocks, as you can see here, after this demand shock in the 1980s calibration, they still co-move positively. So all the shocks in the 1980s calibration generate a positive co-movement between bonds and stocks, not just the supply shock. And that's because of the time varying risk premium. One way to think about it is as endogenous flight to safety. If the cash flow conditions are there to make nominal bonds safe, then an increase in risk aversion makes us flee to bonds. If the conditions are not there, if there are bond market vigilantes out there who think that bonds are risky, then an increase in risk aversion makes us flee both bonds and stocks, and therefore leads again to a positive co-movement between bonds and stocks. Now that leads me to the second counterfactual, which is these prevalent versus realized shocks. So let's start from the 1980s. The blue thing here is the nominal bond stock beta, and I'm plotting here also the beta of just risk neutral bond returns with respect to the stock market. And I do that because to isolate the risk premium component. Now, if I feed in realized shocks from the 2000s, but keep also and the prevalent shocks from the 2000s. So it's changing, basically just changing all the shock volatilities to the 2000 and resolving everything. I get negative nominal betas, bond betas, both with risk premium and without risk premium. That makes sense because now we're in an equilibrium that's determined by demand shocks. But if I only feed in the realized shocks from the 2000s and assume that the equilibrium is still solved as if the shocks are from the 1980s, you see that the nominal bond beta is still positive, so more similar to the 1980s, and the risk neutral bond beta becomes negative. So basically the realized shocks determine the risk neutral beta, but the overall beta, which is of course what we're going to observe in the data, are much more dependent on what's priced in risk premium and what's the equilibrium that investors are pricing. So in that sense, I think it's important because it tells us that whatever we observe is what's in investors' minds and should be interpreted as a forward-looking measure. Okay, then I have a third counterfactual here. The third counterfactual tries to tease out a little bit more, what change in the monetary policy, conduct of monetary policy from the 1980s to the 2000s is important, or conversely, if we see a particular type of pattern in bond betas, what does this mean about the monetary policy rule? So it turns out that this plot shows counterfactuals, comparative statics starting from the 2000s, and then feeding in more and more volatile supply shocks. Nominal bond betas are on the y-axis, and then this shows different inflation rates in the monetary policy rule. And this tells us that the lower the inflation rate in the monetary policy rule, the more negative the nominal bond betas are going to be when there are supply shocks. And this happens because, if there's a supply shock and the Fed doesn't care about inflation, it's not going to hike interest rates, so you don't get as much of a recession, so there are no stagflations. Now, that's one way to get negative bond betas with supply shocks. A different way is to get it is if the monetary policy rule is very inertial, which of course is I would think of as a more benign conclusion of how monetary policy operates. And then if I combine it, we can go from downward sloping, negative bond betas when supply shocks are present to increasing bond betas when supply shocks are present. So it's really a combination of higher inflation rate and low inertia that gives you these 1980s positive bond betas eventually. Okay, and then finally, I can do one more counterfactual, which is the adaptive inflation expectations, which is how backward-looking is the Phillips curve. So here, this is again, as I increase the volatility of supply shocks, how does the nominal bond beta change? And it turns out that if I feed in rational inflation expectations or fairly backward-looking inflation expectations, there's actually not a huge difference here. Actually, it's a pretty small difference. So that tells us that bond stock betas are informative and forward-looking about, do investors think that monetary policy can achieve a soft landing after a supply shock? But they're not as informative about the persistence of inflation. What is informative about the persistence of inflation, we already saw that, is this Campbell-Schiller type regression, which is also, I think, a different dimension of bond risks. And the mechanism is illustrated here. So what this shows here is impulse responses for the slope of the yield curve, the term spread. So it's the 10-year minus, I think, 3-month nominal bond yield. And the Campbell-Schiller regression uses that as the right-hand side and regresses bond excess returns on the left-hand side of it. So what we see here is that after supply shock in the 1980s calibration, the overall yield spread in black and the risk premium move together. That means the yield spread, the black thing, predicts future excess returns, which are, basically the risk premium. For the 2000s, that's not the case. The overall yield spread moves in the opposite direction from the risk premium in many cases, and it's also dominated by the risk neutral part. Right. So the term spread has a risk premium component. Higher risk premium long in bonds is going to drive up the term spread. But it also has an expectations hypothesis component, which is just where do we expect interest rates to go? And if the expectations hypothesis component dominates, you don't get bond excess return predictability from the term spread. If the risk premium, time varying risk premium aspect dominates, you get bond excess return predictability. And so it turns out that the adaptive inflation expectations are important here because adaptive inflation expectations turn inflation into something close to a random walk. Close to a random walk means that the expectations hypothesis term cancels from the term spread, basically, because I expect inflation just to be constant, and then the time varying risk premium can dominate. So it's interesting that this is actually quite in line with a much older literature that has found that the failure of the expectations hypothesis is more pronounced in in periods and places where inflation is persistent. Okay, so this is really the, I don't have a whole lot more prepared, but I just want to show a few plots of what's happened recently, because sometimes these bond stock betas can seem a bit abstract. So recall that with the 1980s shocks, the counterfactual implies that if I have 1980s shocks, but a monetary policy rule closer to the 2000s, we should have negative nominal bond betas, but positive real bond betas. So there should be this decoupling of nominal and real bonds. And the real bond betas here turn positive because basically the real rate is important for whether or not you get a recession. A drop in the real rate means that real bond prices go up, and it also is good for the economy. So stock prices increase a little bit. Yeah. So is that what we saw in the data? So this is really just raw data, nominal yields and break even. This is the pandemic. So you see that prior to the pandemic, nominal yields and break even. I might be mislabeling here. I'm not totally sure. It might be real yields that I'm plotting here. Yeah, I think I'm plotting real yields here. Sorry. So real yields and nominal yields move together very, very closely. And then they did start to decouple after the pandemic, which makes sense because if you have significant movements in inflation, nominal and real yields are no longer equal. So this decoupling from the counterfactual is there. But at the same time, break even continued to move with the stock market. So the blue line here is break even inflation. It's the nominal minus inflation index yield. It's what people often use as a measure of market-based inflation expectations. Of course, there are other risk premium in there and so on, but it's break even in the stock market. The blue and the red line here move together pre-pandemic, and they also move together post-pandemic. So as the stock market went up, break even went up and vice versa. So that's what's going to drive the negative nominal bond stock beta, because yields move inversely with prices, break even moves inversely with nominal bond prices. At the same time, real yields, which is the blue line here, after the pandemic moved inversely with the stock market. So as the real yields went down, the stock market went up, and as real yields went up, the stock market fell. And this tells you, this tells you that yields are inversely related with prices. So this is what's going to drive the positive real bond stock beta. Okay, so then here's just a rolling estimate of, if I strip out kind of the inflation part of nominal bond excess returns, how does this correlate with the stock markets? This is over 6 month rolling windows. This has roughly stayed negative, and I can do this with break even, or I can do inflation swaps, which are sometimes thought to be a little more liquid. But it seems like even though inflation was substantial and it drove a wedge between real and nominal bonds, it still contributed to a negative bond stock beta, which is exactly what we would expect in the model if there were supply shocks to the Phillips curve, which might have reflected a bunch of things, including non-linearities in the Phillips curve, or maybe supply chain restrictions. All of these things would show up as a shock, a shift in the Phillips curve. But the monetary policy response is thought to be much slower and gradual than it was in the 1980s. Okay, so this is from very different data. This is comparing inflation expectations to the inflation swap rate from a paper, from this review paper that I mentioned earlier. And here we also see that inflation swap rates were pretty narrow compared to inflation expectations, which is also in line with the zero or negative bond stock betas, because if bonds were super risky, if there was a huge inflation risk premium, you would expect inflation swaps to be way above inflation expectations, and that didn't happen. So it seems like in this levels swap market versus expectations, also we seem to see still fairly benign expectations of, say, stagflation risk. Okay, so I'll conclude here. It seems like So I've shown you that we can work with a new Keynesian asset pricing model that has interesting things to say about supply and demand shocks, and especially what this means for interpreting bond stock betas, which I think are hugely policy relevant. The message here, and this is a message that I didn't anticipate when I started writing this paper, is that the interaction of supply shocks and fast anti-inflationary monetary policy is really what generates positive bond stock betas, risky nominal bonds, and the risk of stagflation being priced. Now, thinking of it, now that I have the result, it seems kind of obvious, but I was surprised to find this. Now, the time-varying risk premia, endogenously time-varying risk premia, are important not just for the magnitudes. Right? If without risk premia, you're always going to get tiny bond stock betas, and the time-varying risk premia make them large. But on top of that, they are also important for is this something that's can we read off what investors are expecting in equilibrium versus in exposed correlations. And the time-varying risk premia mean that we're really learning something about the equilibrium that's priced, and these bond stock betas should be interpreted as something that's forward-looking. And mostly what we've seen in bond stock betas over the past 2 years, the negative inflation component of bond stock betas has been consistent with a softish landing after supply shocks. So it seems that investors have been throughout fairly optimistic on the Fed's ability to pull off a soft landing, which I think is interesting. And financial markets, of course, can be wrong, but I think it's still interesting to have a framework to interpret the data that we're getting there. Okay, I'll stop here.
All right, thank you very much, Carolin. If anybody has questions, just feel free to jump in or comments. All right, maybe we can leave it at that. Thank you very much, Carolin, and hope to see you all back tomorrow.
My pleasure, and I look forward to the problem set.